Well, the stock market enjoyed another solid session with the Dow and S&P hitting new highs, powered by consumer staples, which continue to attract value investment dollars, and, of course, industrial names led by Caterpillar. Shares of Caterpillar up 60% this year, reacting to strong global tidal wave. And then, by the way, it's only gathering strength. This morning, the company posted its November retail statistics, and the company is simply firing on all cylinders. Industrial sales up 30%, transportation sales up 35%. Oil and gas up 43%, all in up 23%. And geographically, you know what? We saw a negative year-to-year sales story at the start of the year, now morph into 26% overall growth in November, 25% for construction equipment. What about North America? Equally encouraging. Having spent the first 4 months of 2017 in the negative year-over-year comparisons, now taking off. You can see from this chart a monster. I think Caterpillar, by the way, is the perfect proxy for the true building blocks of our economy: physical infrastructure, construction of roads and bridges, mining, and, of course, energy to make it all move. Even with the abundance of strong economic data, however, the Federal Reserve isn't as ebullient about the market or the economy for the next couple of years. It did take its GDP numbers up from their modeling in September, but it seems very conservative to me, with the economic momentum that we've got going into next year, that this would be their data. By the way, currently the Atlanta Fed sees fourth quarter GDP at almost 3%. New York Fed sees it at almost 4%. So I suspect the strong economy will drive the stock market higher, certainly more than most estimates. In fact, according to S&P, to FactSet, S&P next year, revenue growth should be over 5%, earnings growth should be 11%. That's for the whole year. That's huge, and in my mind is good enough to justify this market going higher from here. And let's not, of course, forget the bottom line will eventually be substantially higher because of lower corporate tax rates. That means less, maybe less robust buybacks, but also it means more money to put into long-term business investment, including hiring. Joining me now to discuss, Lindsey Piegza, chief economist for Stifel Nicolaus. Lindsey, am I too giddy over here?
Well, you tend to be a little more optimistic than I am. I do agree that the economy is certainly on more solid footing, but I don't know if the risk is that we go from 2% to 3%. I'm still concerned about the downside risk going from 2% to 1% growth going forward. I still see a lot of confidence, a lot of animal spirits being the underlying support to the domestic economy, as opposed to very realized and positive wage growth or business investment. Those are really the underlying components that I'd like to be seeing driving this market higher.
Well, then let's add into the mix a corporate tax rate of 21, perhaps 22%. Let's add into the mix 6 million job openings. So at some point, that's got to sort of create some pressure, upward pressure on wages. And you might answer those two questions or concerns that you have.
Well, we have seen a tremendous amount of job openings. If we look at the JOLT survey, we've seen ample openings. Businesses, big and small, say, look, I'm ready to hire, but the resumes coming across my desk don't necessarily have the skill set to fill those job vacancies. So I don't see that structural disconnect being filled anytime in the near term, and certainly not because of the tax reform bill coming down the pipeline. And furthermore, businesses, absolutely, on the margin, those struggling to keep their doors open will benefit from a lower corporate tax rate. But some of the bigger guys that are already awash in cash, if they saw an opportunity to increase their margins and grow their bottom line, they would already be doing so independent of this new tax reform. So I really hesitate to say that one piece of legislation coming out of Washington is going to drive the economy, as the president's looking for, to 3%, 4%, 5% GDP.
So before I let you go, finally, then what will perhaps be the determining factor between the downside and upside risk scenarios that you see?
Well, we have to see organic job and income growth. So to your point, if we do see businesses begin to jumpstart that investment cycle, we absolutely could reach a sustainable 3% economy. But if we don't see that, and we simply see cash bloated further onto the balance sheet, then I think 2.5% is as good as it gets, and the downside remains the biggest risk in our forecast.
Lindsey Piegza, Stifel Nicolaus, thank you very much. Really appreciate it.